Everyone who has owned stocks before has made some mistakes. Even Warren Buffett, someone who has made billions throughout his career, has made mistakes as well. If you can avoid these 10 mistakes, you'll be much richer. So here we go. The first mistake is essential money. I'm talking about the money needed to pay the bills or necessities like rent, emergency medical bills, and debts. You realize when a majority of people live paycheck to paycheck, and if they lose their job, the first thing they do for cash is axe down their investments. This is a huge mistake because the investment is still growing, but they need the money and don't have a choice. For your portfolio to bear a lot of fruit is the end goal for investing, but it never gets there because people sell prematurely all the time. To avoid this mistake, build up a couple of months worth of expenses in cash just for emergencies. I always recommend starting with at least $1,000 in a bank savings account. It just acts as emergency money, not money for vacation or fun in case you're suddenly broke. Once you have built up an emergency fund, then the excess money can be considered for anything else, like investing or snacks. Commission costs. So this happens to a lot of people investing with small amounts of money, anything under $1,000. At any of the big Canadian banks, the commissions you pay to make a trade is already $10. To buy and sell costs $20. So $20 commissions on a small $500 investment is already 4% cost. If the average investment returns in the stock market is 8%, then that's expensive. If you're investing with even less, like $200, then the $20 commission is a 10% cost. I used to make this mistake when starting out at TD Direct Investing, and commissions in the old days were $30 per trade, so it would cost $60 to buy and sell. To avoid this mistake, make sure the potential investment gain is worth it, or minimize commission costs in the first place. I usually recommend people to use Questrade instead of the banks for half the commissions and free ETF purchases. My referral link is below and also a promo code for $88 in free trades. Mental preparation. When investing, people are surprised when stocks go up and down very quickly, and it's these movements that cause people to be very emotional. Let's do a quick mental experiment with $10,000 invested over time. This shows you how much you're making or losing. It can be quite stressful losing thousands of dollars and it being out of your control. You can see maybe how people can get really moody when investments aren't working out. It's usually these two reactions. There's a couple things you can do. First is be aware and accept the fact that prices fluctuate like crazy. Second is buying investments that are more conservative in nature if you're uncomfortable with these big fluctuations. And third, you can get to know your stock more to build comfort and understand its potential. Stock levels. Here are some Canadian companies with their stock price. People often think that a high stock price is expensive and a low price is cheap to buy, but that's not always the case. The stock level usually means that the company's value, like a pizza, has either a few slices or a lot of slices. Shares of a stock are always equal, so a lot of slices would be like this. The fewer the number of slices, the larger the size of each slice. Meanwhile, the more slices there are, the smaller each slice. You might also realize when the slices are too small, it's actually not a good thing. To avoid the mistake of stock price levels, what you want is to find a stock where the overall pizza can get bigger and the number of cuts remain low so that you keep owning a large slice of it. Simply stocks that have grown over the last decade is a good place to start looking. Here's CP Rail. After a decade, it's up 500% despite a high share price. And here's Bombardier. After a decade, it's down 93% despite a cheap share price. Somewhat related, a lot of people think about stocks with low prices. What's there to lose? It's so low. Well, if you have $10,000 invested in any stock and the price goes to zero, then you lose your entire investment in any case. Correlation. People always look to companies in the same industry and love investing in several of them at the same time, but oftentimes just owning one company in an industry can perform just as well as owning several. The reason why is because you're not really spreading your risk between several companies. Stocks in the same industry have nearly identical price movements, so you often get similar results between them. There's more general problems like big mortgages that affect the entire industry instead of a single company. If people can't pay back their mortgages, then all bank stocks go down together. Then depending on how much exposure a bank has to the problems or defensive traits that there are to a specific bank, it'll be the difference between one being down 10% versus the other down 5%. To avoid this mistake, I would either recommend people to pick one company within the industry, or if unsure, just buy the industry's ETF to own all of them. Dividend traps. Everyone wants passive dividend income since you don't have to work for it, but there's just so many traps out there. Just because you see a dividend number on your investing platform, it doesn't necessarily mean that you'll get that amount. Just a quick lesson on the dividend yield. It's a percentage of your investment that you expect to receive in cash every year. So Carnival Cruises stock on something like Google Finance has a dividend yield of 15%. So if you had $10,000 to invest in Carnival Cruise stock, then you can expect a 15% dividend yield or $1,500 over the next 12 months. But this is a trap because the cruise business is literally a sinking ship right now and they're too drunk to afford the dividends. So what's more likely to happen is that Carnival will significantly cut or suspend their dividend, which means that you will either be getting much less than 15% or just 0%. A simple way to avoid this is by seeing if the stock has had a long track record of paying dividends during harsh economic times. I would check for years in the past when there was recessions to see if they still paid dividends. Basic homework. People spend more time checking grocery prices than how to invest life savings. When it comes to the stock market, it's easy to go all in. Usually the case is that people buy stocks without understanding what they're getting themselves into. Actually, most people are only familiar with the name of the stock and its basic description. So when something happens to their stock, they easily panic and they mistakenly sell at a loss. To avoid this mistake, it's worthwhile for investors to at least read the annual report for their investments once a year to get a sense of what their stock has done, where it is now, how it plans to grow, when they expect things to happen, why it's doing certain things, and who's involved. It might be inconvenient like a university course, but it beats having no knowledge of what to expect. Consistency. Most people when investing do it inconsistently, or just make a one-time investment and think they're good to go. It's why most people who invest don't see results. Again, it's like growing an apple tree, but you only water the tree whenever you feel like it, and you have the urge to keep cutting off the tree branches just as you see it start to grow. With these kinds of activities, you can't expect your apple tree to grow to a substantial size and be able to bear enough fruit to feed you forever. To avoid this mistake, you can just make a simple plan of investing small bits of your savings every month to ensure that your portfolio is growing over time into your retirement years. Emotional trading. People are quick to buy stock ideas, but when they see something negative about it, they will panic sell out of them just as fast. Sometimes these emotional trades work if you're fast enough, but that's usually not the case because by the time you hear about it or read about it in the Wall Street Journal, it's already too late. Emotional trading situations happen all the time, especially with hot stocks like weed, Bitcoin, Beyond Meat, and Tesla. All the people who made a lot of money on these hot ideas were early investors, so if you're just reading about some new idea now, it's likely old news. To avoid these mistakes, I would wear metaphorical blinders to ignore any trending stock ideas, and do homework by getting to the facts instead of listening to opinions. It's also a good idea to be like a robot and use emotions to your advantage by doing the opposite of what everyone else is doing. When everyone is optimistic and buying stocks, it could be a good time to sell. And when everyone is panic selling, it could be a good time to buy. Sentimental investment. Maybe it was passed down as an inheritance, or you got stock options as an employee, or it made you a lot of money. Then you naturally feel an emotional attachment to your stock. But the only thing that really matters is if the stock loses money or makes you more. The moment you lose faith in it for the long term, then it's time to cut it off. I've seen people own stock of a company that they used to work for and know it's a sinking ship from their experience working there. There's no honor in having an emotional attachment and staying on board when there's zero hope for it, unless you're the captain of the ship and want to ride it to the bottom of the sea. To avoid this mistake, stick with stocks that have at least made more money in the last 3 to 5 years. Check if they're hiring people. If they're actually growing, they're hiring. If the company finds it easy to lay off its employees, then as investors, you should be able to lay off the stock just as easily. So that's all for now. If you enjoyed this video or learned something new, remember to smash the like button and subscribe to my channel. Let me know in the comments below which mistakes you've done before.